Welcome to Integrated Planning, where we take an integrated approach to growing and protecting your wealth. My name's Dyck, and today we're going to take a look at mortgage insurance. If you're going out to purchase a house, you're looking at a house or thinking of buying a house, you're likely going to want to insure that debt and insure that mortgage. And with that, you're presented with a couple of different options. You can either do that through your bank, which the bank will be more than happy to offer you before you walk out their doors, or you can do that in the conventional insurance market. The difference between those two is critical, but is often overlooked by the vast majority of Canadians that have a mortgage on their home. The mortgage insurance that's offered to you through the branch at the bank seems simple. It's a nice, clean option. You can get it done as soon as you're doing the documents. You don't have to bother seeing a nurse. You don't have to bother with an insurance agent. And the coverage is just put in place and it's locked in step with the mortgage, or so you think. The mortgage insurance that you acquire can cover a couple different things. Generally, it covers death for sure, but recently additional options have been added to cover disability insurance. So in the event that you can't work, the disability insurance portion of that mortgage insurance would kick in to provide at least the mortgage insurance payment while you're off work. One interesting aspect of mortgage insurance that's offered through the bank is that it's not medically underwritten. Now, because of that, there's a pro and a con. The pro is that it's simple, as I mentioned before. It's very easy to get. You answer some questions, and if you check all the boxes, yes, you are effectively insured for that mortgage. However, the difference is that the time of claim, in the event that you pass away or become disabled, the medical underwriting actually starts at that point, at the point of claim. And the danger is that potentially, if you're found that you wouldn't have otherwise qualified for that insurance coverage at the time of application, you may in fact have no insurance coverage at all. The ownership of a traditional mortgage insurance policy is owned by the bank, and no bones about it. The coverage is in place to protect the bank's interest alone. It's not there to protect your interest. The bank wants to ensure that in the event that something happens to you, be it death or disability, that they get their money back. That's what they're concerned about. It may seem initially like they're concerned about you. They're really not. The coverage payout amount with mortgage insurance that's offered through the bank is also interesting, because that mortgage insurance amount, particularly on the life insurance side, you may start with a $350,000 mortgage, and over that 25-year amortization schedule, eventually that drops back down to zero. However, your premium payment remains static. So for a 35-year-old male, give or take, at a $350,000 benefit, that cost through the bank, from what we've seen, is roughly $42 a month. But the $42 a month does not change. It remains the same for your lifetime. The benefit, however, does change. It may start at $350,000, but it's going to scale down to $200,000, to $150,000, and eventually to $1 before your mortgage is totally repaid. Mortgage insurance just simply covers the remaining balance on the mortgage. It doesn't cover the initial amount that you set out to when you purchase the insurance coverage. Traditional term insurance that's available in the brokerage market or the open market is completely different. It starts with arguably the same amount at $350,000, but it remains at $350,000 for, it could be your lifetime, or it could just simply be the length of time that you have debt outstanding. However, the premium payment, because it's in the brokerage market and not just the bank offering you the coverage, is going to be less than what you would otherwise pay at the branch. And that payment is going to remain the same throughout the term of the mortgage, on the entire value of that mortgage. So you will pay, in that previous example where the individual was paying $42 a month, when we took that to the brokerage market, the same amount of coverage at $350,000 was only $35 a month. But that coverage amount stayed level for the entire term of the mortgage out to 25 years, and the payment remained the same. So you're actually receiving value for what you paid for. It's not the bank receiving value for what you're paying into, which is a declining balance. The other difference between these two types of coverage, between the bank-owned coverage and the coverage that you would own yourself, is just that. It's the ownership. So with conventional term insurance, it's available through the brokerage market. You actually own that coverage. So in the event that you pass away, your family will receive that $350,000 benefit regardless of what the debt is actually outstanding at that point in time. So your mortgage may be down to $150,000. Your family is going to receive the additional $200,000 over and above the mortgage debt that's outstanding to the bank. Because you own that coverage and your family is the beneficiary of the coverage, anything over and above the debt can be used for whatever your family would like to use that balance for. So as a quick recap, bank mortgage insurance is owned by the bank for the benefit of the bank. The debt is the only thing that's covered. Your premium remains the same, the debt value goes down, and eventually the bank gets their money back in the event that you pass away. Term life insurance, on the other hand, is designed for the benefit of your family. Your family can then make the choice to repay the debt outstanding to the bank on the house, and then any surplus can be used by the family for whatever they'd like. So if you're going out to buy a home and you need a mortgage to go along with that house, make sure that you're aware of the two options. Don't get hammered into just the one option that's available at the bank. Know that you've got more than that, and that prices will vary greatly between those two options. If you like this video, please feel free to subscribe to our channel. If you have any additional questions about mortgage insurance, please feel free to contact your integrated advisor or your CPA.